The stock market, often depicted as a complex landscape of financial opportunity. It possesses the extraordinary capability to transform aspirations of substantial wealth into tangible realities for a myriad of investors. The allure of amassing fortunes through stock trading captivates the imagination of both novices and seasoned financiers alike. Yet to navigate this intricate domain successfully demands a profound comprehension of strategies, risk, and the underlying mechanisms governing its dynamics. So today I'll take you to using stock market magic to turn pennies into profits. If you're new to the channel, hit that subscribe button and that little notification bell icon so that you don't miss out on any of our video updates. Plus, it helps us spread the Thrive Wise love to help more people thrive wisely. Now, let's begin. At its essence, a stock or share embodies a fragment of ownership within a company. Shareholders wield the power to influence pivotal corporate decisions through voting rights exercised at annual stockholder meetings. Moreover, they partake in a portion of the company's earnings, typically disbursed as dividends. This dual function of ownership and profit sharing forms the bedrock of stock investment. Stocks are exchanged on stock markets, where investors engage in the buying and selling of shares through traditional brokerage firms or digital platforms like E-Trade or Robinhood. Notably, these exchanges, such as the New York Stock Exchange, London Stock Exchange, and Shanghai Stock Exchange, serve as the global epicenters where all listed stocks are traded. The price of a stock is contingent upon the interplay of supply and demand. When an investor demonstrates willingness to pay above the prevailing market price for a share, the price ascends. Conversely, scarcity of buyers willing to pay diminishes the price. While this may appear straightforward for an individual stock level, the complexity of the stock market stems from the high frequency of transactions occurring daily, culminating in price fluctuations and volatility. The stock market is renowned for its volatility, characterized by incessant price fluctuations propelled by rapid trading and an array of influential factors. Notably, popular stocks tend to exhibit heightened volatility due to intensified trading activity, making investors reinforce the perception of market instability. Within the realm of the stock market, the specter of criminal activity, including security fraud, looms ominously. Insider trading and pump-and-dump schemes represent two prevalent forms of security fraud. Insider trading involves trading stocks predicated on non-public information, whereas pump-and-dump schemes entail artificially inflating stock prices to allure investors, subsequently selling off at a profit, leaving unwitting investors holding plummeting shares. Regulatory oversight and investor protection are paramount within the stock market ecosystem. In the United States, the Securities and Exchange Commission, or SEC, alongside its British counterpart, the Financial Conduct Authority, or FCA, spearheads efforts to maintain a fair and transparent marketplace. These regulatory bodies assume multifaceted roles, encompassing monitoring, investigation, and enforcement. They meticulously surveil market activities, scrutinizing transactions and behaviors to detect signs of suspicion or illicit conduct. Upon identifying irregularities, they initiate investigations to unearth fraudulent activities and breaches of security laws. The overarching objective of these regulatory entities is to safeguard the integrity of the market, shielding investors from potential scams and upholding the tenets of equitable trading. Through their vigilance, they cultivate confidence and trust among investors, thereby fostering the orderly operation of the market. Now that we have that covered, let's delve deeper into the strategies that fuel investors' dreams and occasionally add a dash of adrenaline to their financial adventures. Imagine yourself as a savvy investor, armed with the age-old mantra, buy low, sell high. It's like scoring tickets to a concert at bargain prices and then selling them at premium rates when demand soars. This strategy, as straightforward as it sounds, demands a blend of Sherlock Holmes-esque market timing skills and a Sherlock Gnomes-level understanding of stock valuation. Investors don their detective hats, scouring market trends and financial reports like seasoned sleuths, all in pursuit of that golden opportunity to snag undervalued stocks before they skyrocket in value. It's a bit like being a treasure hunter, except instead of buried treasure chests, you're seeking out undervalued gems in the stock market jungle. And speaking of timing, knowing when to hit the sell button is as crucial as knowing when to enter the market. It's like playing a game of musical chairs, except instead of scrambling for seats, you're timing your exit to the tune of rising prices. Successful investors possess a sixth sense in market sentiment, like Jedi Masters attuned to the Force, gracefully navigating the ebbs and flows of stock prices to maximize their profits. By the way, if you're enjoying this video, please take a moment to like and subscribe. It really helps us spread the Thrive Wise love, so we can help more people thrive wisely. And going back, now let's talk strategy. Day trading versus long-term investment. It's like choosing between a thrilling roller coaster ride and a leisurely cruise on a luxury liner. Day traders strap in for the adrenaline rush of rapid-fire trades, capitalizing on the market's wild twists and turns, like daredevils on a financial tightrope. But beware, the thrill of day trading comes with its own set of risk and regulatory hurdles, like trying to tame a bucking bronco on a rodeo. On the flip side, long-term investors take a more laid-back approach, sipping Mai Tais on the deck of their investment portfolio as they patiently await the tides of time to swell their wealth. It's like planting a tree and watching it grow, slowly but steadily into a mighty oak, weathering market storms with the resilience of a seasoned sailor. But what about short selling? The high-stakes game of betting against the house. It's like riding a bull on a rodeo. Thrilling, exhilarating, and potentially bone-crushingly painful if you're not careful. Short sellers ride the wave of falling stock prices, betting against companies they believe are overvalued or destined to fall. It's a risky game of cat and mouse, where fortunes can be made or lost in the blink of an eye. That's why you need to be careful, since the risks are as steep as the potential rewards. It's like walking on a tightrope without a safety net. Exciting, yes, but one wrong step could send you plummeting into the abyss of financial ruin. Short selling requires nerves of steel and a keen eye for market dynamics, like trying to navigate a minefield without blowing yourself up. Then we have dividends, the sweet nectar of stability in the unpredictable garden of stock market returns. It's like receiving a bonus paycheck from your favorite company, except instead of a one-time windfall, it's a regular cash infusion straight into your investment account. Investors seeking a steady income streak flock to dividend-paying stocks like bees to honey, drawn by the allure of periodic payouts funded by company profits or cash reserves. It's the financial equivalent of having a reliable roommate who always chips in for rent on time. And there's even more. Ever heard of stock splits? It's like getting a bonus slice of cake at a birthday party. Except instead of indulging your sweet tooth, you're multiplying your shares in a company. Picture this. You own one share of a company, and suddenly, presto changeo, you now own 2 shares without spending an extra dime. It's like doubling your fun without doubling your investments, as the total value remains the same while the number of shares multiplies. Stock splits are like the stock market's way of throwing a party and inviting everyone to join in on the celebration. Now, let's talk about buyouts and takeovers, the corporate equivalent of a high-stakes game of Monopoly. It's like one company swooping in to snatch up another, gobbling up properties and amassing wealth with each strategic move. Imagine Corporation A eyeing Corporation B like a hungry predator, sizing up its prey, offering to buy up a majority of its stocks to gain control of the company. It's a financial chess match where each move carries the potential for profit or peril, as shareholders weigh their options and decide whether to accept the buyout offer or hold onto their stakes for dear life. In the grand scheme of stock market strategies, it's all about finding the right fit for your financial goals and risk tolerance. Are you a long-term investor seeking steady growth? Or are you more of a thrill seeker, dabbling in short selling to capitalize on market downturns? Perhaps you're drawn to the allure of dividends, craving the stability of regular income streams. Whatever your strategy, success in the stock market requires a blend of research, risk management, and a dash of good old-fashioned luck. Well, that's basically using stock market magic to turn pennies into profits. And thank you guys so much for watching today's video. And hey, it seems that YouTube thinks that the next video can completely transform your financial situation. Watch it to find out whether they're correct. And please don't forget to click the subscribe button to see more videos on how to thrive wisely. Till next time.